Good evening, Uncle Sam. How are you? May I come in?
Welcome, Ravi. Please come in. So, Ravi, tell me the topic you studied today.
Uncle Sam, today we learned about accounting principles. They are a little cumbersome.
Yes, Ravi. These are little cumbersome and little challenging to understand also. But they are basic. Principles in any subject are the core of that subject. So you should understand principle of that subject. And these accounting principles, there are 9 accounting principles and they are basic to the subject.
Yes, Uncle, I can understand that these principles are very important. But I need your help.
No problem, Ravi. Don't worry about that. I will explain each and every principle one by one. Worry about that. I will help you. I'm there. So I'll start with the first principle, that is called separate entity principle. Right? It is simple, say what this word says, separate entity principle. It says that business and businessman are different entities. It means both are different bodies. Right? What businessman gives to the business? Businessman gives his money to the business, and which is called capital. Now what business gives back to the businessman? Business gives interest on capital, right? Business may give drawings to the businessman. So this is separate legal entity principle. The simple thing is that never consider business and a businessman as one. They are two separate bodies. Simple.
Thank you, Uncle. And what was that second principle, money measurement principle?
Now, money measurement principle says that the unit of recording should be always money. It may be rupees, it may be pounds, it may be dollars, it may be euros. Okay? We cannot record anything which cannot be expressed or converted in terms of money, or which cannot be converted in currency. Okay? Like we cannot record kindness in our accounts. We cannot record loyalty in our accounts. Correct? Now if we move toward the third principle, which says that accounting period principle. Now you have to be a little careful here. Now this principle says that it is that accounting period principle, that it is a period that which lies between the start and the end. It is mostly an accounting year, not always, but mostly accounting year. Okay? Or we can say that it is a period for which we calculate profit or loss. Or it is that period for which we prepare financial statement. This principle says that a life of a business is divided in small periods. Okay? So that we can compare one period of that particular business to the another period. That is accounting period principle. Right?
That's great, Uncle. It seems little simple.
It is, Ravi. Now I move to the fourth principle, which is called full disclosure principle. Now, I should say that our accounts should be reported in such a way that all, or I should say every important information is visible. Okay? Such information should be fair, complete and understandable. Every economic information which is related to the affairs of business should be mentioned clearly in the accounts. That is the gist of full disclosure principle. Means everything which is important, which has some value, which may have the point, should be mentioned in the books of accounts. If we go to the next principle, which is materiality principle, which also strengthens this fourth one, and it says that every material information which may influence the decision of parties or stakeholders should be mentioned in the financial statement. Although it is a matter of judgment. Like for big firms, for small firms, there might be difference. Okay, but we can't hide material information from the people who are interested in the business. Now, I should continue one more principle here, that is prudence principle, or it is also called conservatism principle, old thinking sort of thing. So, this principle says that while writing accounts, the accountant, that particular accountant, should not assume income unless it actually happens, but should make provision for all the losses even if they are expected. I'll give you example that in business, the closing stock is always valued at cost price or market price, whichever is less. Okay, so that is the example of prudence principle.
Wow, uncle. Now they seems to be very simple.
Now, next principle is cost principle. Now, this principle says that assets should be recorded in the books of accounts, of course, at its cross price, not at the price, market price, or whatever price. The price which you paid for its purchase will be the price of recording in the books of accounts. It may be possible that the value of that asset may go up or may go down in the market, but in books of account, they will remain on their cost. Yes, that is true. By the passage of time, its price may go down, its value may go down, but the base would always be its cost. Right? So this was the cost principle. Now I move to the next principle, which is called matching principle. And this principle says that revenue of a particular year should be matched with the expense of that particular year only, or loss of that particular year only, right? If we talk about, like, say, this year, so this year income and this year expense should be considered for calculating profit or loss, right? And this principle says that you may receive money in advance during this year, or you may have paid something in advance to somebody else, okay? But it will not be considered while calculating profit this year. Okay, so at the end, what we can say that for this year, only income or expense related to this year should be considered, right? And it doesn't matter what you pay, what you receive. What matter is whether it is related to this year or not, right?
Right, uncle. It is quite clear now.
Now, Ravi, last principle is dual aspect principle. It is very important principle, and you will need to refer this principle again, right? And this principle says that your total assets should be equal to your total liabilities. Okay, or you can say that if your assets will always be equal to your capital or liabilities. Okay, this will be a universal truth throughout the accounting year, every moment. Okay, now whatever transaction takes place, whatever happens in the business, this formula should stand still. Okay, if there is a change in asset, listen again, if there is a change in asset, the total will lead to change in capital, or liability also affect liability, or both, right? And this will happen with the assets also. If there is a change in capital or if there is a change in liability, so asset or capital, they will also get affected.
Wow, great, uncle. This was a great experience.
Dear viewers, you are requested to like and subscribe our channel. You are also requested to share this video with your friends and relatives if you find it is useful for them. Press the bell icon and keep watching.
Bye for now. We'll meet again.